Welcome. Welcome to She Means Business. Sorry, I'm doing two things at once, trying to make sure we get everybody in here. She Means Business. This is night 8, I think. If you count the study table, it's 7 if you weren't at the study table. Tonight, we're going to be talking about financial statements. So your profit and loss, your balance sheet, and we're not going to get so technical as to, how do you build these and what does it. We really want you to be able to look at a financial statement and see the story that's being told in that statement. So what's the profit and loss telling you? How did you operate this year? Did you make money? Did you lose money? Where did you make money? How did you lose money? And then we're going to look at the balance sheet, and that's going to tell you what you own and what you owe. So we'll get into that here in just a few minutes. Dave and I are going to bring that to you. So, but a couple of quick announcements. One is that we will have another study table next Wednesday, which is the 28th, Jahida's birthday. We'll do it from 5 to 7, again, like we did last Thursday, but we'll do it next Wednesday, 5 to 7. Come in, bring your questions. We had a pretty good turnout last week, so let's make it another great turnout for the study table next week. If you can't come, that's totally cool. It's not required. It's just something we want to offer to you because we know there's a lot of questions that maybe don't get answered at the time you think of them, or maybe they get asked, you think of them between classes or whatever that is. We just want to be of service to you and give you an opportunity to come and kind of brainstorm some thoughts and ideas even. So come to that 5 to 7 next Wednesday using the same link you use to get in here every class session. Also, the Profit and Loss podcast. We have our interview with Steve Hoffman. Episodes or parts 1 and 2 of that are out right now. You can check that out. And he is promoting his new book, Surviving a Startup. And it's a wonderful book. You can find it on Amazon. It just came out on Tuesday, Surviving a Startup by Steve Hoffman. There's like 80 something chapters and they go really quickly. And it's all about how to start a business, from the very basic things of your idea and your formation up to, kind of broader strategy concepts. So if you want to read that book, I encourage it. I have read it. I have vetted it. And Jahida and I have both had a nice long conversation with Steve, which you can hear on the Profit and Loss podcast. I will get that link to you in the chat today. But that's a great book, Surviving a Startup, if you're interested in that. It's called, Shane, it's called Surviving a Startup by Steve Hoffman. It'll look like this. You can get it on paperback and Kindle, I believe, paperback and ebook. So that's really it for my announcements. We all know what's going on. So now, tonight, we're going to go over financial statements. And it's a lot of fun. I'm excited for this class. Dave and I are both geeking out over this. So if you guys have any questions as we go through, please ask them. We're going to be engaging. And so guys, be ready to answer questions because I know that for my portion, I'm going to be asking some folks to answer. So be ready. Don't turn your camera off just because I said that. I know that that sounds ominous, but this is really for your benefit. We want to make sure you're educated and you know these things so that when you do get a financial statement, so when you do get a financial statement, you can say, I know what this is and I know how to read it and I know how to pull information out from it. So with that, I'm going to invite Mr. Kraus up to talk to us, give us the first part of this presentation and explain financial statements to us. So David.
All righty. Thanks, Adam. Great to see everybody. Thanks for coming out. I'm going to share my screen here. So bear with me. Make sure I share the right one. Okay. Okay, can everybody see that? All right.
Yeah.
Cool. So I'm going to pop this into a slideshow and yep, tonight's financial statements. Jump through. Well, that's a typo. Budgets and projections was Tuesday for all of you who were here on Tuesday, as you remember. We'll mention that later. But for financial statements, tonight's agenda is we're gonna talk about what are the big three, what I like to call the big three financial statements. What are the concepts of each? What do they tell you? How to look at them, as a small business owner, like Adam said, you're in all likelihood, you're not going to be building these or booking transactions into a system to generate them. But once you run them from your accounting system, or your accountant hands them to you and says, here they are, well, you have to know what you're looking at. So we need to understand what's the concept behind each of the statements. And then we're going to get into the mock financials. So for the first 10 or 15 minutes, we're just going to go through some concepts here. And again, to reiterate, there's no such thing as a bad question. If the same question has to be asked 2 or 3 times, it's probably because the presenter is not explaining something very well. So please stop us. And we want to hear from you, because that's what makes this valuable for everybody. So the primary, what I refer to as the primary financial statements are the profit and loss, the balance sheet, and the statement of cash flows. We're not going to talk about the statement of cash flows in any kind of detail tonight. We're not going to look at a mock-up of that, because that's just, we would need another couple of hours, I think. But those are the big 3 that your accounting software or your accountant or whomever does your books or will be doing your books, they'll be generating those and providing those to you. And of note, these are all historical statements. So they're all measured as of today or some prior period. So if you actually are creating one of these for a future period, then you're creating a forecast. But if someone like a banker or a lender says, give me your financial statements, let me see your financial statements, they're referring to some kind of a historical record of how your business has performed. And then that is embedded in these 3 statements here. And if you run across in the world, there's another statement that if you're having an audit done, or if you're filing reports with the SEC, if you're a really big company, there's another statement of shareholders' equity. That is also a primary financial statement. We're also not going to get into that tonight, because it just is not necessary. So the profit and loss, what's on it? What does it measure? Well, you got revenues. Sometimes people will call that the top line number. And that just means your sales or your inflow. Expenses, such as cost of goods sold, operating expenses. We're going to get into that, some specifics. And the outflow. That's what I try to boil everything down to concepts that have nothing to do with money. So you got inflow and you got outflow. Gross profit for those businesses that sell goods, that's going to be the difference between the revenues and the cost of goods sold. We'll see that later. And the net profit's the bottom line. And for a profit and loss, you're measuring something, specifically the profit or the loss of the business, for a period of time. It's a period of time measurement statement. So, for example, you might say something like, my company had a profit of $10,500 during the period January 1 of 21 through March 31 of 21. That would be the kind of statement you would make in referring to a profit and loss. Stop me if there's any questions. Balance sheet, it's a different animal altogether. It measures assets, liabilities, and equity. And like Adam said, it's kind of like assets are what you own, what the business owns. Liabilities are what the business owes. And equity, the difference between the two. So I'm not going to read all the specific items on the assets and liabilities and equity slide, examples of those, because we'll see that in the mock-up financials later. But I will note that equity, if you want to think about what equity means in terms of financials, I like to think about it as owner's stake. Does the owner have skin in the game? Which lenders certainly want to see that you have skin in the game as an owner of your business. Meaning, have you invested in your own business? So when you pull up the balance sheet, is there an equity position that represents your investment, financial investment in that business? Now, the balance sheet is a point in time measurement. That's different than the profit and loss. If you drop an X on a date and you assess what's the value of my company's assets, what's the total of the liabilities, and what's the difference, which would be the equity, that's what a balance sheet would measure as of a point in time. So you might say something like, my company's balance sheet shows assets in excess of liabilities of $15,750 on March 31st, 2021. So it's a point in time taken as of one day. Now, statement of
Hey,
cash flow.
Dave,
Yeah, sure. Yep.
David, can you go back to net profit? Sonia had a question about net profit again, just the definition of that and then how you reach that number.
Yeah, that would be if you're selling goods, then you're going to have a cost of goods sold and a gross profit on your profit and loss. So net profit is really, in that case, it would be revenues minus your cost of goods sold minus all of your operating expenses gets you to net profit. So it's revenues minus all of your expenses. And if you're not selling goods, you don't have a cost of goods sold. So all of your expenses would be operating expenses.
I have a question, please. Since we're talking about this, like when you're talking about goods, the cost of goods and everything. So last night, I was looking at your example of the Excel workbook sheet, and I was working on my budget. And I got down to, it says, so in group A, I put like my t-shirts and my mask, but I was trying to understand, because when it says under an assumption, it says product group A is higher volume, lower margin, and vice versa for group B is higher margin, lower volume. Could you explain that to me, please? Because I was trying to look it up, Google it last night, and I didn't quite get a clear understanding.
Tell you what, since we got so much to cover on the financial statements, and we'd be going back into the budgets and projections from Tuesday if I go down that road. Can we pick up that at 7 after we conclude the financial statement presentation for everybody? Would that be all right?
That's perfectly fine, or I can just hold it off till Wednesday. It's no big deal.
Okay. All right. Well, if you're interested at 7, we can revisit anything from Tuesday, or anything from tonight that we don't get to. How's that? Okay.
Thank you.
Sure. All right. Let's go back. Statement of cash flows. Like I said, we're not going to look at an example of that tonight, but it measures cash flows, which is if you think back to Tuesday, I just said we're not going back to Tuesday, but every effect, inflow or outflow in your business bank account is found on this statement in some way, shape, or form. This is just a way to organize the information with fancy terminology. That, trust me when I tell you, this statement makes people's heads spin, including people who do this for a living. Reading it, interpreting it, knowing. So all we're trying to do is let you guys know that something like this exists. What does it tell you? I can say it in one statement. It's every hit, inflow or outflow on your business bank account over a period of time. So if we jump all the way to the bottom, you might make a statement like, my business generated $3,500 in positive cash flow for the month of January 2021. That's because you started the month of January with one number, you ended the month of January with another number, and that ending number was $3,500 more than what you started with. That's what it's telling you. Now, just to summarize, profit and loss, period of time, operational activities of the company, balance sheet, point in time, financial condition of a company, because you're talking about assets, liabilities, and equity. And statement of cash flows is a period of time. Was cash generated over a period of time for the company, or was it used? Did your cash position for your company, did it go down or up over a period of time? Now, before we get into the mock financials, I find two of the most potentially confusing concepts in this entire kind of world of financial statements. Why are some things on the profit and loss and not on the balance sheet, and vice versa? And what's the deal with the statement of cash flows? Well, this deal with the statement of cash flows is really, let's go back. It's a period of time measurement. So it's kind of like the profit and loss, only because it's a period of time. But do you have more cash at the end of a period in your business bank account, or all your business bank accounts? Did you have more cash at the end of that period or less as compared to the beginning of the period? You can really summarize it like that. Don't get too hung up on the terminology and how those activities and how all the ins and outs are categorized. That's not as important as just understanding whether or not you made cash or you lost cash for a period of time. The first question I posed was, some items are on the profit and loss and not on the balance sheet and vice versa. You kind of got to look that to answer that. You just look at what each of these statements is reporting on. And the fact that one is a period of time measurement, so over a period of time, and the other is a measurement of a point in time. One of them is talking about revenues, which is your sales, expenses, and then the difference. So those are very different concepts from what's the value of my assets, what's the value of those liabilities that I owe, what's the total of that, and then what's the difference, what's the equity ownership stake in the company. If once we get into the mock financials, I think maybe a little bit of this will make a bit more sense, but they just measure different things and they measure them for different periodicity. Now let's do the numbers.
Cool.
All right.
All right. Are we all ready for this? We're actually going to go through an example of a profit and loss sheet and of a balance sheet for a business. So I've created this imaginary business, and I've got the financial statements for it here. So if you guys are ready, I am ready. And we're going to have a lot of participation on this, so be ready. Can you guys see my screen? Yep, cool. All right, I'm going to have to minimize this, pull it up here. Okay, so this is, okay, I don't want anybody looking at this. I'm gonna stop sharing for just a minute. So, and I'm going to speaker view. Okay, so Brenda started a business, and Brenda makes biscuits, all right? And she started her business, and it's called Brenda's Biscuit Barn. All right, everybody loves biscuits, whether you want gravy on them or not. I prefer to not have gravy on them. I know that that's a sin, but I live with that. So Brenda she's starting a biscuit business, and what she does is she makes biscuits. She makes the dough for the biscuits, and she also is now teaching people how to make biscuits because her biscuits are so good. People want to know how to make them, right? So what she's done, she's now, it's 2021. She's now going over her financial statements from 2020. She's been in business for a few years. She's starting to grow, and she wants to see how well she did in 2020. So what we're going to do first is look at her sales and her expenses for 2020. And that's where we're going to look at the profit and loss, the profit and loss. So we're going to pull that up. I guess I have to share my screen again. So we'll pull this up here. Now this is the profit and loss. Now what I'm going to do is I'm going to hide all the months, and maybe I'm going to hide the months. So we're just looking at the year end, because that's really all Brenda cares about at this point, is just looking at the year end to see how she did for the entire year. So we will hide this. Now we can just see this, right? So you guys can see that for sales for the year for 2020, you guys jump in. If you have questions, jump in. Her sales for the year totaled $187,112. She did a ton of sales in 2020, right, for her business. And that was broken down two ways. So 75% of her sales just so happened to be $149,690, ton of sales. And that was her product sales. So she was actually selling biscuits, selling dough to other people, selling all of her products that she made. Her service, where she teaches people how to make biscuits, that was $37,422. Still a nice chunk, but only 25% of her total sales. So that's the revenue. That's the money that came in on the business, right? Those are all, every nickel that came into the business as a sale came in through either product sales or service sales. Then we had cost of goods sold, right? So can anybody, I'm gonna ask for this, I'm gonna be the annoying teacher. Who can tell me what does cost of goods sold mean? What would be a cost of good?
Wouldn't it be what she actually sold as opposed to I'm gonna pay you later, or no?
Not quite. Allie Lawrence, you have your hand raised.
Yeah, cost of goods sold would be the ingredients that she used to make the biscuits, the packaging and things like that, that went into the actual physical product.
Right. Very good, Allie. Thank you. Good job. So if you just break that term down, if you know nothing about business, if you've never gone through a class like this at all, if you know nothing about business financials, I should say, you can look at that phrase and go cost of goods sold. So this is the cost of the goods that I sold, and I sold $150,000 in product and $37,000 in services. So, and those are her cost of goods, right? So what we do to get our gross margin tells us, are we charging more for our product than we're spending to make it? So to get our gross margin, we take our sales, our revenue, minus our cost of goods, and that gives us our gross margin. And our total gross margin is $109,173. So for her biscuits and her service, after she takes out all the stuff that it took to make that into, whether it's the packaging, the flour, the butter, the water, whatever that was, after she takes out all those expenses, she has $109,173 left for the year. Is everybody cool with that? Are we all straight on that? I'm trying to see if I can see some faces. I'm just going to kind of click through here. So then we go into the operating expenses. So we've talked about the money that's coming in, and we talked about the money that it took to get that money, and we talked about the money that we sent out really in terms of that product. So we spent 50 cents on making a tin of biscuits, and we brought in $1 for that tin of biscuits, right? So we've talked about that money. Now we need to talk about what it takes to actually run the business, the operating expenses, and that's right here. So we have payroll. For the year, Brenda paid herself $36,500. We have the payroll taxes there. We have health insurance, fringe benefits, workers' comp, disability, rent, utilities, insurance, maintenance. So what I'm going to do, I know we talked about this a little bit on Tuesday, but I'm going to ask if anybody can point out an example of a fixed cost, and if somebody can give me an example of a variable cost. If anybody remembers what those terms were from Tuesday, a fixed cost and a variable cost. Sharice, your hand was the first one up.
A fixed cost will be something that is stable, like a rent. A variable cost, it would be something like maybe I bought the dough at one price and it varied from this price and it went up later. That's a variable.
That's pretty. That's really close. Variable cost is going to go up as your sales go up. So a variable. So your rent, you're really close. You're right there. So you are correct. Rent is a fixed cost because rent stays the same no matter if you sell nothing or if you sell $10,000 in the month. Right, that cost stays the same. It's fixed. A variable cost is going to vary based on your level of sales, based on your level of activity. So think about flour. She's making biscuits. The more flour she buys, the more biscuits she makes, the more flour she has to buy. So her flour expense is going to go up, right? The more, and if she's making more biscuits, she may have to hire more people. And so that can be variable as well. Faustinia, you have your hand raised. Hello.
Yeah. Hi. How does she determine how much she's paying herself? Is it based on what she wants to get paid, or how do you break that down if you're just starting out or you're just adding something new to your overall?
It's a really good question, and what I want to do is we have opportunity to talk about that in other classes because it's we could literally take an hour to talk about that because there's a number of ways you can do it. And I know that we have that question. If you want, I know we're answering a similar question tonight at 7. So if you have time to stick around, or we can talk about it on Wednesday at the study table. But there's a lot of different ways to talk about how to decide when to pay yourself, how to decide how much to pay yourself, and even how do I pay myself? Do I pay myself as part of payroll or an owner's draw? And it's going to be very specific to the business, and there's really no formula of if I have X and then Y, then I do Z, or if I have A and B, I do C. It's going to be very specific to your business and kind of the financial situation as well as the operational flow. So
for this
I hope
example,
that
you just made it up. You just picked the
yeah,
number.
I just made up her. I just made up.
Okay.
Yeah,
Cool.
all these numbers are made up. So, but good question. It's a very good question. It's a necessary question. So, so we go through all these, and then we get down to we get down to this total operating expense, right? So what does it take to run the business? $79,000 for the year. $79,099 for the year is what it takes to run the business. And then on the profit and loss, we have some other types of expenses that are non-operating. They don't go into, you know, it's not money that's being used to run the business. We have things like interest expense. So she has a loan. She took out a $60,000 loan this year to buy some new equipment, right? And to help with operations and things like that. So the interest she paid on that loan, she can expense out. And she's got that $4,559. So if we add that to the total operating expense here and here, we have the total expense. Now you'll notice we are not adding in the cost of goods sold. We're not adding that number into our total expenses because it's already been taken care of here. We took sales minus cost of goods to get our gross margin, right? So now we got our gross margin. We're going to hold on to that and we're going to bring it down, and we're going to take all of our total expenses out of that gross margin, and that gives us a net income of $25,515 on the year. That gives us our profit. That's what we'll refer to as our profit. We had a net profit of $25,515 on the year. That's pretty good, right? I mean, we want a positive net income. That means we're running the business in a profitable manner. So now what I want to do is overwhelm everybody and show us. So I only have one screen with me today. So now I want you guys to look at this. This is every month. So we have January here, December here, and then we have the yearly totals here at the end. Take a look at this. I'm going to start asking some questions. You know, when did her product sales start? Did her product sales ever go down? Can anybody tell me that? I know we've got people in the chat. I should probably pull the chat up too.
It doesn't.
No.
They went down. No.
Okay. Did her service sales ever go down, or did she have consistent growth throughout the year?
Consistent growth.
Right. Very good. Very cool. So that's good. You guys can see that because you can see here product sales continue to go up. They go up, they go up, they go up. Her service sales go up every month as well. Her total sales go up. And then, so you can see cost of goods are, oh, sorry guys, I am trying to look at the chat at the same time. Her cost of goods are going up as her sales are going up, which means they're what kind of cost, fixed or variable?
Variable.
Variable.
Very good, wonderful. Good, because they're varying with the level of sales. Her rent, you can see right here, her rent stays the same even as sales go up. So that makes it a what kind of cost, fixed or variable?
Fixed.
Very cool, wonderful. Thank you, thank you, thank you.
It will help if I turn my mic.
What's that?
I was saying fixed, but my mic wasn't on.
Oh, we'll give you credit anyway. That's good. So yes, and Connie makes a good point. Keep in mind, these are all hypotheticals. This is all an imaginary business that we've drawn up. But the point is for us to understand what the numbers are telling us. What kind of decisions can we make when we look at the numbers, right? So let's look at payroll. If we look at payroll and we look at total sales, those are the two lines I want you guys to look at. Payroll right here and total sales up here. what's it look like happened right in here? We see that payroll went up $1,000 a month, but we also really kicked it into high gear. We had been at a manageable, let's say a manageable level of sales. And then once we get to this point, let's say it's Brenda, because we can see that it's a small salary every month, or it's a salary for just one person probably every month. So then we got here and we saw that once we hit that $15,000 in monthly sales, Brenda needed to bring on some additional help. So as sales grew, she had the opportunity to hire somebody, and she had the need, more importantly, to hire somebody, to bring them on to help her increase sales. Because what would have happened if Brenda didn't hire somebody? What if her payroll didn't go up? There's a good chance that this number wouldn't have gotten much higher, because there's only so much as a business owner you can do. You have to have help at some point. Otherwise, you're going to max out. You're going to cap out. But if you can bring people on, and you know that, okay, I'm not going to be able to go above here if I don't bring somebody in. Once you bring somebody in and you can look at these financial statements and know what an additional person or what some outside help will do. Sorry, I'm hearing stuff in the back. Once you see all that, once you have that information, you know that if I bring somebody else on, my sales can go up. But if you're bringing somebody on, you have to make sure that your expense of bringing that person on makes sense. You can't bring somebody on, increase sales, and then lose money, right? So if we go down here, you can see that as she brought somebody on, that month she brought somebody on, make sure I'm telling the truth here, her first month of bringing somebody on, her net income dropped $500. She didn't lose money, but she had a smaller net income than she did the last month. But what happened the next month? It jumped huge. She was able to produce more. So that's her investment. I know this is getting kind of next level, but I want you guys to know that these are the kind of decisions. These are the things you need to look at when you're looking at a financial statement. You need to look at the relationship between numbers and things like that. So let's pull back for a second. Okay, so we've got our sales, got our cost of goods sold, we've got our expenses. So if you come down here and look at expenses, you see our payroll went up. What also went up? What other expenses went up when our payroll went up? I'll wait for an answer.
I see health insurance went up.
Yep.
Payroll taxes went up.
Very good.
What
Yep. So all those.
Oh, I'm sorry. $5.
No, go ahead.
Oh, I said
Go ahead.
Workman's comp went up $5.
Yep.
Office supplies.
Yep.
So she brought another person in, and she added more expense in the payroll column, which means her payroll taxes have to go up because they go up together. Your health insurance and workers' comp and disability are also going to go up if your payroll goes up. You're adding another person to the team, so there's going to be a greater need for supplies and things like that. So that went up as well. And you can tell all this. You don't even have to ask Brenda what happened. You can just say, oh, your payroll went up, which means you either hired somebody or you gave yourself a raise, and all these things went up. You don't have to ask Brenda a single question. As a matter of fact, you can ask Brenda better questions. And by Brenda, I mean yourself. You're going to be able to ask yourself better questions by, if you go through these and you analyze this and you take a look, you can go, huh, did this decision make sense? Did adding somebody make sense? Did adding another employee make sense? Well, for Brenda, it did. Because even though her net income went down that first month, she had a new employee. It went up because that other person made her more productive, and in turn made her more profitable in terms of dollars. But there's some things that didn't go up when Brenda hired a new person. Depreciation expense didn't go up. Her bank fees didn't go up. But you can see. Oh, sorry, somebody trying to get in. No, okay. You can see that her bank fees. One thing I wanted to talk about here, this is important. And if you guys, I know there's a lot of information coming out tonight, and please stop me and ask any questions. Money you don't have to spend, money that you shouldn't be spending, money that is just being taken out of your account because of things like overdrafts and bank fees, because maybe you're not keeping a minimum deposit in there or something. If you can reduce those kind of fees, you can save. I mean, you can really save some money here. These numbers are really small. You know, like a $12 monthly charge is not a lot. But if you bounce like 4 or 5 checks, or if you overdraft your account several times through your debit card or whatever, as a business owner, it's going to start to hurt. And what you need to do is, these are the kind of forms you're going to be able to look at, the profit and loss and the balance sheet. You're going to be able to look at those and go, okay, where am I spending too much? And okay, I spent way too much here, and I didn't manage my cash. You've got to have a really strong grasp on your cash, and knowing when your cash is coming in, when it's going out, so that you don't run into things like Brenda did here with, you know, she spent $234. She just gave money to the bank. There's no service there. She just gave money to the bank because she wasn't watching her cash come in and out. She wasn't managing that properly. So keep that in mind. It's not really a huge lesson for tonight, but it's something you guys should take with you. So also here, I'm going to try to scroll up here and show, so we can see Brenda spent $1,500 in this month, in the month of April, on professional fees. Everything else was less than $400. Most months were $125. If you're looking at this, you know how the world works. What happened in April? Why'd she spend $1,500 in April? Any guesses?
Taxes.
There we go. Wow, a great answer. Perfect answer. So I'm not saying that's how much it's going to cost you to get your taxes done. This is clearly a wild amount, but that's why her stuff went up. But you see, you're able to see the story of Brenda's business start to unfold as you look at these, as you look at the columns and the rows, and you go, oh, $1,500 here, that was for this. And then you can go down and see she had a loss for that month. You know, Brenda was losing money. And let's talk about net income. So net income is, again, your sales minus your cost of goods, which gives you your gross margin. So sales minus cost of goods, your gross margin. You take your gross margin and subtract all your operating and your non-operating expenses, your total expenses down here, and that gives you your net income, right? And your net income is your total profit. It's all the money that came in through sales minus all the money that went out for expenses, right? So net income. That sounds like fun.
Somebody's really enjoying this. Yeah. Okay.
Yeah. So you guys can see, we can all see here that, and I will try to make this a little more visible. So on total sales of $8,750, Brenda lost $1,796. Just for reference, just for your information, when you see parentheses like that on a financial statement, typically that means it's a negative number, right? So she lost $1,796. Her sales went up the next month to $9,625, and she only lost $1,300. As her sales went up, so did her net income, right? So now let's kind of stop there for a minute. I want to see okay, Sharice, you have a question. Anybody else? But I'll start with Sharice.
Okay, so I'm on the sales. Where'd you get the number? Yep. You said she made okay, let's go. I'm on February, $9,625. And then you went to the bottom and the loss came in through the numbers. Is that what you was looking at? Through the calculation of all the numbers? Is that where that number came from?
Yeah, so she had total sales of $9,625. Her cost of goods on those sales, so what it took, you know, the product, the raw materials and all that it took her to produce those goods that she sold, those cost her $4,909, which leaves her with a gross margin, that gross margin, $4,716, right? So then we subtract all of our operating expense.
Everything else. Oh, I got it.
And
I
then
got
our
it.
nu-
I got it. I clearly
Yep,
have,
cool.
I do my taxes the exact same way. Everything is on here is exactly how I do my taxes.
Good, very good. That's the way it should be. You should be able to account for all of these expenses and all those revenues as well. Anybody else have questions? For real. And look, no question is stupid. No question is dumb. No question deserves to go unanswered. So please ask your questions.
So I just want to be clear, as piggybacking off of what Felissa said. So you, first of all, you add the sales. I'm just using where you all were in January, which is the $87.50. Then the cost of goods, which is the $44.63. So are you subtracting the 42? So what are you? Okay, so you're subtracting the 44.63 from the.
So,
please, from the 87.
Yeah.
Okay, and then you go ahead.
Yeah, I'll walk you through it again. So for sales, we have two types of sales. We have our product sales and we have our service sales, right? So we charge people for the products we're selling. We also charge people for the services we're providing. I take both those, I add them up, and those are my total sales for the month. So 7,000 plus 1,750, that's 8,750. And I'm going to leave that number there. Don't worry about that number. We'll come back to it. But now, what did it take for me to produce the goods that I sold to get that 8,750? What did it take? How much did it cost me? It cost me $4,200 and $263. So my total cost of goods, what it took me to produce those items that I put out, total cost was $4,463, right? So now I've got my total cost of goods and my total sales. If I want to get my gross margin, think about you guys have a piece of paper, right? So your margin is this piece. It's what's left over. It's the part on the page where it's after the line. What's left over? That's your margin. Think about it that way. So you're going to take your sales minus your cost of goods to get your gross margin. What's left over? What's left of my sales after I pay for what it cost, after I pay for those sales, right? Your gross margin is $4,228 in the month of January. So now take that number. Oh, go ahead.
So your gross margin, if you didn't say we didn't have any of these operating expenses, the gross margin is what we would take home, right? Before operating expenses, before we would add the operating expenses to subtract them, the gross margin is what we would take home.
Yes, yeah, yes, but you're always going to have some
theory,
kind of,
yeah. Renat, in theory that would be true, but I don't think there's a business in the
No,
world.
I'm just trying to make sure I'm putting all the pieces together. So I know like when I do my operating expenses, they have to come out of my gross margin. That's what
right. Yes, very good. Yes, your operating expenses will come out of your gross margin. So, and having a positive gross margin tells us that we are charging more for our products than we are spending on making them, right? So if you have a positive gross margin, if it's above zero, it means most of the time that you are charging more for your product than you're charging more for it than you bought the raw materials for, which is what you're trying to do. So that's good. So now we take our gross margin and we put it to the side. Don't worry about it. We'll come back to it. So let's go to the operating expenses. Operating expenses, we've got all of these operating expenses and even our non-operating expenses. We'll lump them in together. Don't think too much. Don't worry about the difference between an operating expense and a non-operating expense. Just, it's all in the same grouping here. Think about them together. The total of those is, and I should have made this a little bigger. I'm going to do it now. The total of those is $6,083. And my Excel is going to either crash on me or come back. There we go. Okay. My total expenses, and this is just the things in here. This does not include our gross margin. This does not include our sales. It does not include our cost of goods sold, right? So remember that this does not include your cost of goods sold. It's just these expenses right in here. Those total expenses are $6,083. So then we take our gross margin up here and we subtract our total expenses. Because remember, our gross margin is what's left over from our sales and our cost of goods. Then we subtract our total expenses and we come down here, we've got a negative number, right? So we're almost breaking even. We're almost to zero, but we're not there yet. We're $1,796 in the hole, $1,700 in the hole right now. Let's look at a different month so you guys can see what a positive net income looks like. So stay with me right here in July, right? So we had $12,401 in product sales. We sold a lot of biscuits. We sold $3,100 in services. We taught a lot of people how to make biscuits. Our total sales for the month were $15,501, right? So we've got that number. So we're going to hold it over here. Then we've got our cost of goods sold. It's a whole different bracket. We got, it took $6,200 for us to make all the biscuits we sold. $6,200. It cost us $620 to provide the services we provided, whether it's, you know, whatever those items are that went along with the service. And I know you're not supposed to have cost of goods sold for a service, but I'm trying to make a point. Our total of our cost of goods, so what it costs for us to provide our service and to create the biscuits we sold, $6,821. So then we go back to our sales and we say, hey, sales, we have to pay for you. So we're going to take the sales minus the cost of goods sold, and that gives us our gross margin. That's what's left over, right? It's the margin. It's what's left. $8,681. So we've got that. We're going to put that away for a minute. Come down to our expenses. Oops. Come down to our expenses. We've got payroll tax, all these operating expenses, the things that we're not using them. It's not the flour. It's not what goes into the product. It's how the business operates to support the sales of the product, to support, you know, it's the marketing. It's all that stuff that it takes to run the business.
So can I take
all of?
I'm sorry.
Sure.
So you said, I'm sorry for interrupting. So you're saying, so with the non-operating, like you said, everything, so like the light bill, the water bill, things like that, or not?
Yep. So utilities are right here.
Okay.
Right. So utilities, that's an operating expense. It keeps the business operating. You have electricity and water, so the business can continue to operate.
So when you're saying non-operating expenses, excuse me, because I'm trying to understand what would be a non-operating expense. If it's not the light bill, water bill, those are operating. So what would be a non-operating? I'm sorry,
right. So first, I don't want you to get too hung up on the phrase non-operating expense. This is more of a, it's more of like an administrative thing for how the statement has to be set up. You won't have to worry too much about that. But a non-operating expense would be something like the interest you pay the bank on your loan. It's an expense going out the door, but it doesn't go to actually running the business, if that makes sense.
Okay, thank you for clarity.
Okay. Yeah.
Adam, can I add one thing?
Sure, please.
Can you scroll up just a little bit? Adam color coded this, and I just want to, if you'll notice, the cost of goods sold section and the operating expenses are all in the same color. So that's all expense. It's just a different kind of expense, the cost of goods sold. It's the cost of the flour and the ingredients to make those biscuits. But all of that in pink is coming out. Those are all expenses. It's a different kind of expense, and it's an important kind of expense, the cost of goods sold. That's why we have this thing called the gross margin, because when you're in this kind of work, when you're running this kind of business, you want to know what your margins are. You want to be able to evaluate that metric anytime to figure out what your sales less your cost of goods sold were. But at the end of the day, this is still a negative. All the stuff in pink, red, whatever that is, those are all coming out of the green.
Thank you, Dave. I should have mentioned that. Thank you. So if you guys think about it, green is money, right? Green is good that's coming in. So the sales are green. That's the money coming in. The red is the money going out. The red or the pink is the money going out. The yellow, it's not coming in or out. That's the money that's left. That's the money that's left. And here at the very bottom, if we get back into July, we've taken our sales. Sorry, I gotta scroll down. We've taken our sales, and we've taken out the cost of goods sold. We had our gross margin left after that. We cut off our cost of goods from our sales. We've got our gross margin left, and now we're taking out all of our operating and non-operating expenses of $7,298. After we cut those off from the gross margin, we get our net income. And I think we had a couple hands raised. I know there's questions. What questions do you guys have? And we've got time for them, so we'll move to the next one here in a minute. But what questions do you guys have?
I had a question about the service expenses, because where goods you sell, you have the operate, you have the things that you buy for it. For what services, you're the person that's creating the services. So do you delete your part from the services and have that at the end? If you understand what I'm saying, like, so I'm the person that's doing the services. So do I delete my rate that I charge to do it, and then that's what's left over for the services? If it kind of makes sense. I don't know if I'm making sense.
No, it's a good question, and Dave, you can jump in here, but that's still payroll. So if you're I think.
Let me take a shot at this, Adam. And I understand where she's coming from, but let me give you an example of a cost of good that may have been associated to services. Individuals that present might have CDs on their presentation. And they pay for the production of that CD. That is actually a cost of service based on what's being provided as a matter of their business. If you're charging a particular rate overall based on these numbers, you would solely fall into the payroll side, not necessarily the aspect of the cost of service area. Does that make sense?
Yes, that totally makes sense. That's why I wanted to see if it was payroll, or do it comes into the product. So I just wanted to make sure if it was separate, or if it just goes strictly payroll. Now I understand.
Yeah.
Thank you.
Yeah, no, good question. Because and that goes into, if you're paying yourself and all that, because if you think about it as, if I'm a consultant and I charge $100 an hour, that money that comes in, I don't get to keep that $100 an hour. I have to use that $100 to pay all these other expenses. And then whatever's left over, I can use as part of my payroll or whatever, but I still have to use all the money that's coming in to me. Even if I'm charging $100 an hour, I don't get to keep that. I have to use that to fuel the business. It's the gasoline that keeps the business running. But that's a good question. Other questions? No? Cool.
I do. I'm sorry, Adam. I do.
Yeah, go ahead.
My question was, okay, so this budget sheet, like I said, I do most of my taxes like this. There are certain things that I don't do. Who exactly is this for? Is this for investors? Is this for just bookkeeping? Or is this for tax purpose?
So I don't. It can be for it can be for your taxes, of course, and it can be for investors. What it is this is the product of all the accounting work you do for the year, or for whatever period that is, for the month, for the quarter, whatever. I know that I look at my financial statements every month. So I look at my profit and loss every month because it's my measurement of how I'm doing. It tells me what happened last month. Remember, your budget is kind of like, here's what I want to do. Your profit and loss is a statement, like Dave said, it tells you what happened. So you want to be able to take this and look and say, here's what happened in the month of March, and here's, you know, boom, 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 boom. I brought in this much in sales, and this much money went out. And so if it's the product of your accounting, of your bookkeeping, of those journal entries, and you use it to understand where you are, how you've been, and then you can look at trends of, okay, in January I did this, and in March I did this. My sales went up, you know, 30%. What else can I, you know, I'm not really sure why. You know, here's an example. So a few years ago, I was working with a client, and he said, you know, my sales dropped by 15% from January to April or May. And I said, well, do you know why? And he said, no, I'm not really sure why. Well, then we went in and we looked around, and he had just stopped spending money on Facebook ads. And we said, well, what if you try to bring up what if you try to go back up to spending money on your Facebook ads? And when he did that, he saw an increase in sales. And then what he did was went in and looked at his web traffic and all that. And he could see, or his sales traffic, and he could see where his sales were coming from. And a lot of them were coming from Facebook. So he could tell by the P&L that as his marketing budget dropped, so did his sales. And he could tell there's a relationship between these two, or at least a correlation between these two things. What is that? Should I explore that more? So it's your statements are here to help you understand your business and make decisions.
I have a question as well. So I've been in business, let's say about 10 years, you know, doing well. I've never did the aspect of establishing a legit payroll. So primarily, you know, applying for grants and things of that nature, during the pandemic, you know, profit and loss statement is one of the documents that you needed to provide. Is there a way that you can provide an accurate profit and loss statement without an accurate payroll?
I was gonna ask you to answer your own question, because if you don't have accurate payroll, then you don't know your expenses, right? You don't really know what went out, or how it went out, or when it went out. So
well, I do know the expenses as far as, and I can see the trajectory of what's in my account opposed to what I do keep my expenses, but I never paid myself, I would say. It just be in my account and I do what I want because it's my money, right? But I didn't like write a check, or I didn't, you know how like I'm in a process of getting that together now, but so it was kind of hard or difficult to kind of say, okay, I made this, opposed to I knew what I spent out, but I didn't really know what I brought in consistency because it wasn't like monthly, quarterly, or things of that nature.
Right. So your income statement, if you want to build a proper income statement, you have to have good bookkeeping practices, and you have to have good accounting practices and all that. So, and I'm also going to say something that I just feel Kimberly Mitchell just saying it in my ears, that, you know, you said it's, you know, the money was mine, it was in my account. Well, if the money's coming into the business, it's the businesses, right? And you have to kind of let it go to the business so you can run the business. And so it's, right. I don't want to say it's not yours, but I will say that I think first it's the business. Kim, you have any insight on that?
Did you see me shaking my head? That money belongs to the business, and the business pays you. So when you single and all of that, that is where we talked about piercing the corporate veil. You are operating that more like a DBA and just mingling those funds. When you go to do any type of financial transaction, like a loan or line of credit or anything like that, they're not going to take your estimate or your PayPal printout or your bank statement ins and outs. You need to have a structure for that.
And that's exactly what I'm dealing with. That's exactly what I'm dealing with. She was trying to work it out by seeing the consistency in my business account. You know, she was trying, but she just said she couldn't because there was nothing legit. So I understand. So that was my question, just to see if there was a way around it while building it to be a professional business. But understood. Thank you for that information and insight.
Good question. I think a few people probably had that question or that same thought. Any other questions on the profit and loss before we move to the balance sheet?
Yeah, I have a question. So, I know we saw the negative like net income, like she took a loss in those few months. So when you are, so I'm in the process of growing my business. I'm going to be buying equipment. I'm gearing up, buying lots of ingredients for a lot of sales in May. So when you are recording this stuff to go into profit and loss statements, should you also notate like, hey, I'm buying extra ingredients for this thing, or I'm, planning on purchasing this piece of equipment, so that it's easier to kind of correlate what's happening if, the numbers are very different radically across a period of time?
That is such a great question. I'll answer, and then I'll let any of the other program leads answer. So for me, I'll speak as somebody who's I've been doing business lending for a while. When somebody comes to me and they show me their P&L, that's the information I have, and I can get a pretty good picture of what happened in the business. I can say, okay, your expenses went up, this happened, yada yada yada. And even if I have, let's say I look at this one, right? If I look at this this P&L, I can say, okay, your net income, you had a negative net income here, and then it was even more negative here, but eventually you started to make some money. Then I can look up here and say, oh, well, this is, your sales went up or whatever. If you can come into me and say, hey, I will tell you why my sales went up. I will tell you why why my, and we'll get into a little bit on the balance sheet too, hey, here's why I had all this expense in inventory or whatever, all these, here's why I had a huge expenditure in inventory and, or a piece of equipment or whatever. If you can have those notes and you can provide that to your lender or to your bank or to your investor, your partner, it just makes it so much easier, because then we get not just the narrative of, I spent $5,000 on these ingredients last month. I know I won't see any sales from it for 2 months, but this is why my cash is lower or what, or my net income, whatever. And then you can pair that with the P&L. You can not compare, but you can pair that with the P&L and get the full picture. That just makes you an even stronger candidate and a stronger business owner, more importantly. So, but I'll let Dave and Kim and Yasmin and Mike and Connie answer too.
I was just going to say that I that's how I go about assessing it. I know it's been a while, a couple of years now, since I've looked really at other people's P&Ls from when I was previously at RIT Center for Urban Entrepreneurship. But that's exactly it. You do want to have some kind of record of what you're buying and what you're buying it for, if for no reason, other reason than the possibility of an audit. You always want to be able to account for everything, which not only goes to the actual funds, but the rationale for the use of certain funds, especially if sometimes you look at a P&L and you have questions. And this conversation is interesting because I was doing a focus group yesterday with a forensic accountant. So she was talking about these very issues to see if, funny money. But yeah, that's how I would do it too, as Adam said.
Yeah, and I will actually jump off of what Yasmin actually has said. And I'm going to make this interesting comment. Khadijah made a comment about what she was not able to do or the difficulty that came about because of the attempts to try to access some additional assistance and funding through COVID assistance that was given by the government. Everybody who actually did not keep records, did not keep clear records or complete records, most all of them were not able to access that funding, which is one of the reasons why there was a little bit of some concern in Washington about the fact they put all this money out, but there were all these people that they know are businesses, but they weren't applying and they didn't understand why. And the reality was they did not have the documentation that they needed because it was not kept. And trust, and I tell you, people are not told, especially if you were a sole proprietorship, okay? Or even a single owner LLC, you had the same issues. Your accounting, what they're going over here with regard to the income statement, the balance sheet, and eventually to touch on the cash flow statement are enormously important, because whether you know it or not, you were explaining to people who don't even know you that, yes, I had a problem. I suffered in COVID. This is the evidence as such. And oh, by the way, I can document the fact that I have this evidence if I need to. So keep those records.
That's when I first started in this industry in venture capital and startup lending and business lending and all that. My boss came in on like the third or fourth day of my job and wrote on a sticky note, "Prove it," and just put it on my desk. And for 3 years, it stayed in the same spot, because that had to be my mantra to business owners, and even to myself as a business owner. You can tell me all these things happen, but you got to prove it. You got to have proof of it, whether that's your sales or how your sales were impacted, or you bought this piece of equipment, but there's no there's no receipt, there's no serial number or what. Prove it. When you go through, when you're running your business and you're going, oh, my sales went up. How do I know that? How do you know that? You got to be able to prove it. Back it up. Get the numbers. The stuff you're most afraid of, the stuff you're going to be most afraid of in business is going to be what we're looking at right now. It's coming to terms with the truth of your business. Are things going well? How are things going? And are you doing what you need to be doing as a business owner to take care of your business? Your business will not grow without you. Your business will not do well without you. The health of your business is your responsibility, and that includes keeping accurate records, being organized, making sure that every nickel that goes out is accounted for, and that every nickel that comes in is accounted for. So keep all that in mind. Just prove it, prove it, prove it.
Yeah, just to kind of piggyback on it, everything that's been said very well. I would never hand a profit and loss to someone without notes, without assumptions, without the factual record of the major items on the schedule. Adam showed that the growth occurred. Well, what drove that growth? How many people are being funded by the payroll line item? Could be 2 half-time people, could be 1 full-time person. What happened in July when the payroll went up? Those kinds of facts that would be provided on a separate page or below this schedule demonstrate that you know what's going on with your business, and you can explain these trends, and that's going to go a long way for someone else to have more confidence in you, whether it be a lender or a partner or whatever.
I can, if absolutely. And if I could just add something, I'll use an example from my own business, my own company. Sometimes what you find, depending on what your business is, right? What you're selling, whether it's a product or a service, if you are starting to go heavy into advertising, especially on social media platforms like Facebook, you often will find that you will spend a lot of money outright with very little to show for it, at least initially. And what happens during that process is that really you're trying to figure out what your customer acquisition costs are. And so that also goes to the picture of, oh, do you have this expenditure that's going through the roof for advertising with little to show for it, but maybe 2, 3, 4, even 5 months down the road, once you figured out the right social media strategy, you start to get more sales, and then you get your bang for your buck. So that's something to consider too, especially for those of you who have products that you're seeking to put out there. Service is applicable too, but especially for products, if you're seeking to go beyond your local geography.
Absolutely. Good point. Good point, Yasmin. We'll go with Rose. You have a question?
I already asked
Rose?
it. That was the question I asked before.
Okay, cool. Sharice.
Okay, here I go. My question is, okay, so this form, I think maybe a lot of us might know. I'm about to show you guys, I am a true believer in, this is how I write my stuff down. I have a book that I write in ledger out. Now, most of the stuff that you're showing is, I will write it out literally. It should be better on a computer when I can't even access the computer. That was my question.
If you can have things digital, if you've got it, look, I take a ton of physical notes. So I write a lot of stuff down, but I always try to get stuff digital, especially with financial records and things like that. You want to have it digital. It's easier to modify it. It's easier to recalculate things. You can make sure your calculations are correct. It's easy to aggregate things. So get on Excel, get on Google Drive and get the Excel there. Yeah, if you can put it into digital format as your final form, that's great, because it's easier to send to people, including people like me. If I'm going to look at a loan request for you, I'm going to want to see it in digital, because then I can read the numbers. I know that they've been calculated, and it's going to be easier for me to manipulate the numbers when I put in things like a loan amortization or whatever. So if you've got to do it, longhand, do that. But my recommendation is to put it into a digital format too.
Is this something that you have to, is this something we can download? Is this something we can access? Is this something I need to hire somebody for?
That's up to you. So this will be in the, we'll put this in the Google Drive, so you guys have access to that. By the way, there's no more Dropbox. It's Google Drive.
Right.
We get that's for everybody, not just you.
Oh, I just downloaded that today. Oh, God. Yeah, okay. Yeah.
Good. So, but I'll have this in the Google Drive, so you guys can look at this, use it as a template if you want to. So, and just kind of think through all those expenses and stuff. But there's things like QuickBooks that you can do accounting for, or you can find a bookkeeper, or you can hire an accountant. There's a number of ways to do it. It's whatever you're most comfortable with and what you can afford. So just think about all that. Shanice, and then I'm going to get started on the balance sheet, and then we'll come back to more questions. So make sure you're writing your questions down, because I want to answer them all, but I do want to make sure we're getting to the balance sheet. But Shanice has been waiting.
Hello. Okay, so say if you already had a business and you never did all of the paperwork, how do you go about tracking your old sales and stuff from before? If you say if I wanted to go apply for a loan and I just started in May, but I opened up last year, how do I account for all those months that I don't have any record for?
How can you prove to me that there was sales? Is there a bank account? Is there a Square account? Is there somewhere where the transaction was conducted where you can show me, hey, money went from this person into this account, or I generated a receipt here, or, is there some kind of digital timestamp or something?
Okay, I do have Cash App.
Okay. Yeah, see if you can pull records from that even.
Okay, thank you.
Yeah, absolutely. And then I know we've got a couple more questions. I'm going to get started on the balance sheet. I will come back. Everybody's questions will get answered. So the income statement is it shows you how I did over this period of time. So typically it's a month or a quarter or a year. So you can see here's everything I did over the course of a year. Here's how things went, right? And it's all about sales and expenses. Then we move into the balance sheet. Fun. The balance sheet is all about what you own and what you owe. Okay, so what you own are your assets, what you owe are your liabilities, and then there's also equity, and we'll get into that. So when you look at a balance sheet, you're going to be looking at things, it's going to be most liquid to least liquid on the assets. So what's the most liquid asset any of us have? Cash, right? So Brenda has $15,000 in cash. I want you guys to write, before we get into this, I want you guys to write down an equation, and it's just letters, there's no numbers. I want you to write down assets, so A equals LE. A equals LE. That's assets equals liabilities plus equity. And we'll get into what that means in just a minute, but write that down. That is your balance sheet formula. Okay, so When you have assets, you have current assets, right? So those things I have right now that I own, that if I got into a pinch, I could go liquidate these things, right? Go sell these things or use them, or I'm going to get cash for them rather. So cash, I've got cash in the bank. She's got cash in the bank. Accounts receivable, those are an asset, right? Because she can count on money coming in from those. She knows she has $8,511 in accounts receivable. So she sold product to somebody and she gave them terms. So they haven't paid her for those yet, but she sent them out and she knows they're going to pay within 30 days or 45 days or whatever, right? So she sent them, 5 cases of biscuits, 5 pallets of biscuits. And they say, okay, I'll pay you in 30 days. So she's got $8,500 outstanding that's going to come in. That's an asset. Inventory. She owns that inventory, right? She hasn't turned it into sales yet, but she's got it as inventory. She's got all that dough, the flour, all that stuff is ready to go. And the difference between inventory and cost of goods sold is that the inventory she has not yet been sold, right? So the cost of goods is just inventory that's been sold. Just think about it like that. The inventory that has not been sold goes on the balance sheet. If she sells it, it's a cost of goods sold and it goes in the P&L, the profit and loss. So she got inventory. She got supplies that she owns. When you pay for a supply, it's now an asset. Certain supplies, you have that asset and it goes on your balance sheet because you own it now. Prepaid expenses. So I'm not going to get into this too much. I don't want to confuse anybody, but so we all pay for insurance, 6 months in advance. Some of us pay for insurance like 6 months in advance to get a cost reduction, right? Well, she has 6 months of insurance that she just paid for, but she has not received the insurance on that yet, right? So she hasn't received the coverage because she paid for it in December, but she's covered for January, February, March, April, May, June, but she hasn't lived in those months yet. But she still has that value she's holding, and this number every month will go down, $150 or whatever that is. It'll go down as her, I can't do math, but it'll go down by whatever that monthly charge is, right? So her prepaid expense will go down whatever that monthly charge is. So those are her total current assets. Then we have things like property and equipment. So this is the equipment she owns, and she took a loan out to get the equipment. And Dave, I may ask you to hop in on the depreciation stuff because I'm going to explain it like a nerd here. So the equipment, she bought a $45,000 huge piece of kitchen equipment, right? And she can expect to get 5 years of use out of that kitchen equipment. She can expect to get 5 years of it. Well, what the government allows her to do is to basically write off 1/5 of the remaining value of that equipment every year. So it depreciates in value, which it does. So you have something brand new, and as it gets older, it becomes less and less valuable. Okay, so she has her equipment, it's worth $45,000 minus the 1 year, because it's 5 years of useful life. So 1/5 of 45,000 is 9,000. So we take off $9,000 in value, and that leaves her with $36,000 in equipment assets.
Can I just clarify?
Is that right, Dave?
Yeah, I just want to clarify one thing. The 45 is what she spent on her kitchen equipment. So we're in this example, we assume she did that a year ago. So there's 1/5 of that $45,000, which has been expensed and appears on her profit and loss. And we saw that on the other tab. So the 45,000 is often referred to as cost or historical cost. It may be worth more than 45. Like if she had to sell that equipment tomorrow because she had a real problem in the business and she had to liquidate assets or whatever, the 45, the value of that equipment might be different than the $45,000, but that's the cost. That's what she had to spend on the equipment to bring it in and start using it. But it's assumed to be a 5-year useful life, like Adam here has said, and 9,000 is 1/5 of that. So what's the net the net value is the wrong word. The net cost of that equipment on her balance sheet at this point is $36,000. That's what appears as an asset.
Thank you. That's much better than I budgeted. Thank you. So we've got our equipment, we've got our cash or our current assets, and then we have our intangible assets. Don't get too hung up on this, but we have things like our logo and trademark. We've got a value on those. We have things of her recipes, her biscuit recipes. She's got the best biscuits in the business. So she's got recipes worth $25,000. And we take all those, we take our cash, our supplies, our equipment, our logos, our recipes, all of that, and that gives us a total assets of $103,604. So that's that. And then we go down to our liabilities. So these are the things we owe. Our assets are what we own, and our liabilities are what we owe. That's what we have to pay out. So we have accounts payable. We got some bills that we haven't paid yet, but they're sitting on the desk, $2,500. We've got our accrued compensation and benefits. So that's her final pay period of the year was December 18th through December 31st. Those 14 days there. Her employees work those days. She also worked those days. She's not paid people for those days yet, though, right? So you don't get paid before you work. You don't get paid the day you work. You typically get paid, a week after the end of the pay period. In most cases, a lot of cases. So she has this accrued compensation and benefits. She still has to pay people for what they worked, but she hasn't put that money out yet. So she owes her employees and herself $2,700. And that's what this accrued compensation and benefits is. Then we have the income taxes she hasn't paid for the quarter yet, at least the federal ones. She has, and then any other accrued liabilities that come into play. So her total current liabilities, things that she's going to be having to fork money over for here soon, $10,992. Then we go into the longer term. So we have her note, we have her loan. The balance on her loan, her original $60,000 loan. She's made 12 monthly payments on it. It's currently $53,337 is what she currently owes on that. So her total liabilities are $64,329. But we know that in our equation, assets have to equal liabilities and equity. Well, assets are $103,000, liabilities are $64,000. So we're off some money here. We're not quite there yet. So hold on a second. I got a math issue here, but we'll fix it. So where's my math issue here, Dave?
No, I think you're good. We got prior year plus net income gets you to the current retained earnings, which is the same as the current shareholders' equity. So, I mean, we can touch that up before we upload it. The math works out, doesn't it? 64 and 43 gets to 108. Yeah.
Oh yeah. So yeah, this number's off. Am I?
It is? I think you're okay.
Well, anyway, okay.
Assets, so, the 10, what? 108. Oh,
108 and 103.
How did that? I missed that, Adam. I apologize. Jeez.
That's cool. I thought I had it yesterday, but I must have. Anyway, sorry guys. So imagine this is 103,000 down here. We just got a calculation error in the Excel sheet because we're also working with a table over here. But imagine this says 103 and change. But let's focus right here. So Dave, do you want to take us through I will bungle this in MBA speak. So I will.
Yeah, you won't, but sure, I'll give it a shot. The shareholders' equity is the difference between your assets and your liabilities. When Adam said A equals L plus E, assets equals liabilities plus equity. And this math error, we'll get that fixed before we upload it to Google Drive. But this is one measure. Somebody asked the other night, what's my business worth? How do you know what a business is worth? This is perhaps one way you could say, okay, this business is worth, according to this method, there's probably 6 different ways to value a business. You could say the business has $43,887 in equity. It would be worth that. because when somebody asks what it's worth, they're usually asking what's the equity value of a business. And that's what that means, is the owner's skin in the game, the owner's value of the business. Because you have to take what you own and back out what you owe, and the difference is that 43 grand.
So we've got this number here that goes into the shareholders' equity. We've got the net income, and we pulled that from the profit and loss. So that's the value that the business created. That's the net value the business created for itself in the year. It's that exact number there, comes right over here, and it's added into the value of the business. So I know we've covered a lot, and I know we could probably do 5 more hours on this. I mean, believe me, there are entire semesters devoted to the analysis of financial statements. So, but I want to open it up for questions, and I know some people have to go. Thanks for hanging out, guys. Enjoy your weekend if you have to go. That's totally cool. We'll see you Tuesday, but I know we've got some hands raised, and I want to get to anybody and everybody who's got their hands raised. And I want to start with, let's see here.
Well, while you looking, please don't. Please don't.
Say that again, Renette.
Please don't forget the payroll.
I won't. I'll get to you on the payroll.
Okay, thank you.
Shanice, do you have another question?
No, I don't.
All right. Okay. Sandra.
Yes. Hi, Adam. I thought I had it, but I got stuck on the question when you guys were talking about if you're contracting and you pay yourself $100, you're getting paid $100 per hour, and all of the service you pay yourself, and also the products that you have to purchase to support that contract. I believe you said that is part of payroll. And so in my head, I started thinking, okay, am I still separating out the cost of the products that I purchase to do the contracting, and then from subtracting that out, and that's would be the remainder of what I pay myself? Or is that my fixed cost probably would be what I pay myself, so that there is some profit from that $100 per hour? Am I breaking that $100 per hour down, or am I throwing it all in as payroll?
No, I guess it's up to you how you want to really do it. But if you're thinking of yourself as a business, if you have your business, you take that $100 and that $100 goes to the business first, right? And you have to pay for, you use that $100 to pay for whatever, and then you're not necessarily, and Dave, feel free to jump in, but you're not paying yourself per, off of each job like that. What you're doing is putting money in, and then if you're on payroll, you're paying yourself a specific amount every week or every 2 weeks or every month. And you can, you're not just taking that, you're not just taking that $100 and saying, okay, I'm going to get 40 here and 30 here and 20 here, necessarily. Dave, you may be better at answering this. I know you are.
Sure. I would view that 100 as it's going into your top line. It's your top line revenue. And like Adam noted, in a consulting type business, a service business, which is what it sounds like you're describing, you've just got to cover all of your operating expenses of that business. Now, there are multiple options for how you pay yourself. You can put yourself on payroll, and that becomes an expense of the business. Or you don't put yourself on payroll and you get into the world of owner's draws, which is a separate animal altogether. But for simplicity, if you put yourself on payroll, that's a cost of the business, so that whatever you're paying yourself has to come out of that $100. But like Adam said, typically it's you accumulate that money and pay your expenses, through the regular course of business.
Okay, so if business A gives me $1,000, I put that in the green as service sales, that $1,000, and then any products that I have to purchase for that, I would put that in the pink cost of goods sold services.
Now, when you said business A gives you $1,000, you're not saying the customer that paid for your services.
Yes, the customer that paid for my services. Yes.
Okay. All right. Yes. Then that's $1,000 in sales revenue. Yes. Correct.
Oh, okay.
Yep,
and everything else, as far as what I had to purchase for that customer to make that, excuse me, to provide that service, that would go into the cost of goods service line, not the products that you have.
Yeah, if you have that type of situation, yep, that would be appropriate. And then all of your other operating expenses, have to get absorbed somehow and paid somehow. So that
and so when I pay myself, that would be the payroll expense then.
If you're paying yourself on a payroll, yep, on a payroll, formal payroll.
That may be a fixed expense in itself for that. Okay, thank you.
Sure.
Good question. Looks like Connie has her hand up. Connie, we charge you for questions, but we'll let you ask for free tonight.
Questions from the chat that I was enjoying very much. And I think this is a David Kraus question. How do you value your secret recipe, your logo, how do you value those intangible assets of your brand?
Adam, can you call up the glossary? Because I actually put the definition of intangible assets in the glossary this afternoon. Because when Adam had it on the balance sheet, I said, oops, I missed that. So we want to get that in there. And I think if we read it together, it might sink in a little bit better, what I wrote.
Yeah, 1 second, Dave.
Sure, yeah, no problem. There's a lot of information here, folks, so thanks for hanging with us. And we hope you found it helpful, but please continue to ask questions.
Hi guys, this is Lola. I just want to shed some light. I was working with Dave, and I'm pretty sure I gave Dave a couple of gray hairs. He helped me with my projections and statements and things like that. He opened my eyes to different things that I didn't know as a business owner that I should be taking in consideration. So I do catering. I make treats and I do some event planning. And so Dave always says, "Oh, how long did it take you to make it?" And I'm like, "Babe, I don't know. I just do it because it's naturally, I just do it." He said, "Well, how much did it cost?" So a lot of the things or the services that you provide, you have to reevaluate and take time out and really write it down. How long did it take you to do it? How much did it cost? Dave even broke down as far as the measurements of how much butter, how much sugar and things like that. Things that I'm like, it's a bag of sugar. It really wasn't important to me, at least I didn't think it was. But when it comes to the money and the time that you're doing these things, because at the end of the year, I'm trying to quit my job, but we'll see how that goes. I'm horrible in bookkeeping, but Dave did help me and enlighten me on things that I was doing. And
didn't know that you need to take that stuff in consideration. So when you're putting out a product, you need to take in consideration the container, the label, the sugar, the butter, everything that you purchase and how many things are in that package that you purchase. You got to take all of that in consideration. How many, if you make jewelry and there's 12 beads in there, how many jewelries can you make out of that bag? So it's a lot. If you're not a good bookkeeper, you probably better find somebody. I've even tried doing the envelopes, keeping the receipts when I go to the store in the car, and then going back and putting them in. If you don't have a computer, write it down, but you have to take, as Kim Mitchell will say, business owner steps. And maybe in the morning you have to schedule some time to do, to write these things down and keep it on track. So that's my spiel. Thank you, Dave.
Thank you, Lola. Yeah, that was just to kind of clarify, amplify a little bit of what Lola said. Lola did a lot of that work. You know, I would suggest we go down a path, and she would go do the research. And you know, this is what it takes to make this product. So she's not giving herself enough credit. A, but B, we really did get into the weeds, and it's necessary, in particular when you're selling a product where your entire business structure is based on selling high volume, low dollar cost products. You've got to have a repeatable process. And so you really need to know exactly how those products are made and exactly what those costs are, and have that down, because you're going to need to bring on help because you can't do it all yourself. You have to be able to communicate that very repeatable, specific process to the people you bring on, so that your quality of your products is maintained. I think Lola and I got through a lot of that. It was eye-opening for me too.
Dave, is this the?
Yes, the intangible assets. We were talking about intangible assets largely. You mentioned they're kind of like assets you can't physically touch. At least that's what I like to think of them. So the value of brand name and patents, intellectual property. The weird thing about where goodwill, let's say, which encompasses brand loyalty, brand identity, a quality customer list, you know, a great workforce. These are things that you don't see on a financial statement as individual line items. They're usually grouped under something called goodwill. But you shouldn't see goodwill on a balance sheet, like a value assigned, a positive value assigned to goodwill, unless that business was sold and the buyer paid more than the value of all the other assets on the balance sheet. So if all the other assets on a company's balance sheet are $50,000, but someone came in and paid $80,000 for that business, and now they own it. Well, they have a balance sheet for that business that they just bought. The difference between what they paid and what the value of the tangible assets that you could see and touch of 50. I'm simplifying it a little bit, but this basically that's how this works. The difference between the 80,000 and the 50,000 most likely appears as goodwill on that buyer's balance sheet, and that sits there and sits there and sits there on the balance sheet.
Can I make a comment to that particular question that originally also came up, because I think part of that question was, how do you value it? And I'm going to give you not a banker's perspective, but I am going to give you one as an asset valuator. Does that intangible actually have value, i.e., if I sold it to somebody, is there an amount that they would pay for it? So in this particular case, we used the recipes had a value which was determined by somebody, because Adam had made a comment, there are a lot of ways to sit around and do evaluation, but it was determined in some way, shape, or form that it had value. But that value is somebody actually going to pay for it, or I have it and this is what I'm looking to sell it for. Prime example, the Colonel's recipe for Kentucky Fried Chicken. That is an intangible. It has enormous value. When you are buying to buy the recipe itself or to buy the business, you're going to pay a lot of money just to have the secret recipe, which, by the way, is not really secret, but anyway, but it has value. There are some people that have a lot of, and Dave talked about goodwill. You know, people, and I got to put it this way. People start businesses, have businesses, and think they're going to sell the business. But what you have to ask yourself is there anything in the business to sell? You started a business, you ran it for 30 years, but you're the one who ran it. You had employees. It was run out of your house. What are you selling?
I always caution clients against naming their business after themselves for that reason.
Good point, Connie.
You know, if
But
it's
is there a value?
Jeannie Jones, you know, consulting, and Jeannie Jones is gone. What's it worth? If you built your whole brand up on you having to be there.
Thank you for that.
Some people have customer lists. They'll sell the customer list. That has value, okay? Because it's an immediate access to a client base that you may already have. And so therefore there may be some technical value there if you're generating the kind of money that people want to see. But, you know, intangibles are valued, like I said, Adam said it beforehand, there are a variety of ways that it can be done. But the bottom line is, if you walked out on the street and said, I have this intangible, would you buy it from me for $25,000? Most people will probably say, no, probably not. You go to somebody that's buying your particular business and say, this is worth $25,000 because this is what's helped me to make my money.
Mm.
They might actually do it.
Yep.
If you operate your business as though you want to raise the value of your business to someday sell it, if you use that criteria for your decision making, you'll be glad you did.
Well put. Yep. Thank you, Michael. That was helpful. That was a good distinction you made.
Jaden, you have your hand up. You've had your hand up for a minute.
Yeah, so I wanted to go back to the with the services and goods that, like, if you're giving something, like either you're donating it or you're using it as like, hey, I get, because when I started 6 months ago, I reached out to people in the community. I was like, hey, come get, like, people that were well connected with other people. And I said, hey, come get a massage for free and then recommend me to somebody else. So I didn't get paid for that, but I provided that service. Is there any way that that would go into the budget sheet or any record of that, or yeah?
I would certainly record it as a sale, a $0 sale. You want to track your activity, but there's no point that I can see for you to track it as some kind of a donation or anything like that. But you want to know what you did.
Okay. Give me a massage anytime, though. I think she also has to track what it cost her to give that massage that she didn't charge for. Like if there were lotions or oils or
right? The costs would absolutely track the costs, because those are real dollars out of your checking account to, make that happen. But as far as the sale goes, I would track it as a $0 or reduced cost sale or whatever, for sure.
Okay. And then another question I kind of was trying to ask last week, but I was on my phone and my phone was being silly and I couldn't actually type. In regards to payroll, because right now, like, I'm doing all of the services, right? But as a massage therapist in New York State, we are legally allowed to profit share. So like if I have another massage therapist and she goes and does a massage for me, legally we can agree on, okay, you get 40%, I get 60%, and just like that. Do I like, and so then that she would be considered like a contractor. Do I just make a note of like, all right, how many contractors do I have, or do I still have to go in and do like a payroll something? Like, does that make any sense?
Contractors are not put on payroll like you think of payroll.
Okay.
Okay. They're just not. They're not directive employees. You are not necessarily responsible for all the taxes that you have to match, things of that nature. Okay.
And then I would just keep that as a line item of like contracted hours.
So sales.
Yeah, I would, because you're trying to track how many massages they gave and then at what rate and all that. You want to track that, and then, and Dave, feel free to jump in too. Yeah, you want to track that, the number of massages, what the split rate was, what you owe them, and then when you pay them, my recommendation, and I may be wrong in this, my recommendation is you take in 100% of the money, and then you pay them out on one check for whatever period, whether it's every week or every 2 weeks, every month. You pay them out for everything they've done on one check, and please do it on a check or some kind of direct deposit or something. And don't do Venmo and Cash App and all that. You need something a little more sophisticated.
And ideally, they're giving you an invoice for those services. We're assuming that this contractor that they passed the test as not being an employee, and they truly are a contractor. But we're kind of glossing over that because there is that test.
Gotcha.
Okay, all right.
Well,
but Adam's absolutely right. You want to take in the gross amount on your books, and then there's the expense that you pay to the contractor, and that shows up down below under expenses.
Okay.
So you put it in as gross. You record the full amount and then the net amount, the amount that goes out to the contractor as well.
You have that look on your face.
It's just one of those things where I'm like, all right, well, okay, now I have to stop paying people on Venmo because it's just the easiest thing. But
Jaden, do you bank with anybody?
Yeah.
Do you have a business bank account set up?
Yeah.
Okay, go to that bank and call that bank and say how much for one box of checks. It's not going to break you, and it's going to save you so much headache.
Okay.
Yeah.
Okay. All right. Thank you.
Cool. Yeah. Thank you. Good questions.
You still got that look, but that's okay.
Yeah. The next in line is Louisa.
Yeah. Well, when you provide the service out of the home office, how are you going to figure all those operating expenses like utilities and all the things that have to happen in order to provide that service?
You would want to talk to whoever does your taxes, because the home office deduction is a fairly complicated beast.
Okay, thank you.
Yep.
Yeah. Charisse.
Okay, I got a million of them, but I want to go back.
It's time for me to go. I will
No,
see
no,
you-
no, don't go, Michael. Don't go, Michael. Cut it out.
Don't leave, Michael.
Listen, okay, so I wanted to ask a question anyway. So she was asking about paying out and she was doing Venmo. Is Zelle a reputable thing that she can do? Zelle them out of her bank account? Because I do that a lot.
So I used to pay my rent using Zelle. But if I'm running a business, I don't know. I'm a little more old fashioned, I think. But Connie brought up a good point about PayPal. as long as you know where that is going and it's secure between you and them. And I know with Zelle it's bank to bank, and it's free with there's no fee or anything, which is awesome. I'm looking. This is my input, and then everybody else is welcome to give their input. I have a box of checks. I probably write 5 checks a year for my business, but it gives me peace of mind. I can send that to them. They probably hate that because they have to like deposit it or go to the bank or whatever. But whatever you can do to make sure you have a timestamp, a date stamp, and you can ensure that it got to their bank and you protected your own bank and your own account. That's my recommendation.
Your business account, if it's coming out your business account, when you get that, you get like a form out of your business account to say what all that transactions went on. Isn't that on there as far as expenses? I think it is. I haven't done my taxes yet. I'm going to work on it.
Yeah,
but yeah,
it's on there, and I think it does say like who the recipient was. So
yeah.
I mean, as long as it's got the recipient on there.
That was not
Yeah.
my question. I was just trying to help because I do use Zelle and I pay a pretty penny out of paying the rents and different things like that. But my other question was,
Sharice, I got a quickie for you. Sharice, you actually pay using Zelle, use your business account in using Zelle? Because I thought Zelle normally access personal, not business accounts.
no, I use it through my business account. I use it because I'm paying the building expense out of my business. It's for business. I use one account exactly for that, and everything that I do, and I pay him right out of Zelle. He has Zelle and it goes right to him, and I know what it was for.
You at least have a record, and this is interesting. I'm surprised, Adam, you're really more old school than me, but there is a really interesting perspective because everything is literally going electronic. It's definitely going digital. Mm-hmm. And so the big concern is Venmo has been shown at least to be problematic. I don't personally use Venmo, quite honestly. But you need to have a pay per record type of system, like PayPal is that same kind of thing for individuals that are quote unquote, getting paid. The bank in itself, if there's an ability to do a direct pay to their particular account. But the issue is if you're going to do electronic, you got to have a record of it, like Adam said, when it was done, the amount, how, whatever. Because if you do not have that record, the transaction just did not happen. Is that a written down
record, or is that something on a computer?
Written down, yeah, that's nice to have. Not doing anybody any good when you're actually trying to physically justify that this was real.
Yeah, because I have a ledger of all my bills and what went out and dates and times and everything like that.
But the electronic, and you can have that conversation with Adam about you trying to do something with regard to trying to figure out how to put it electronic, whether it's Excel, Docs, whatever. But you need to make that stuff electronic because the issue gets to be, and I was going to say this earlier, listen, you go to the bank, nobody wants to have a book that has the receipts in it, the conversations to write out. We want to take a look at a singular sheet, income statement. What are you doing? If you happen to have a balance sheet, we definitely going to want to take a look at that to see exactly what your value is. And we're going to want to take a look at that cash flow statement to see, are you actually pushing cash month to month that shows you can operate the business?
Yep.
It is on the account, but I think the only way I will back that up is to make him give me receipts, and then that goes on what you were saying. I would actually just have him, if it was not found, I would go to him and say, okay, I need you to write me receipts for the last year.
Yeah, just asking for receipts. The number is, you have to put it down, but it's got to be, you should have an income statement every month that shows what you're bringing in, what you're spending. If nothing else, if you had nothing else, you need to have a digitized income statement.
Digitized. See, I'm writing things down. I am very, dinosaurish. Okay, that was one part. And the other part was about how to pay myself. I meet with payroll on Monday for my new business, but I also want to pay myself out my own business. I get the money that goes in, I put everything in, but I don't know what I'm supposed to do about paying myself.
So here's what I'm going to address a couple people's questions right now. Ronette, are you still with us here? Because I'm going to talk about, okay, cool. So,
Right here waiting. Take my hand down.
When you are ready to, you know you're ready to pay yourself when you have the money to do so, right? So if you're not producing income, if you don't have revenue, if you don't have customers, no real reason to have yourself set up on payroll, right? So once you get to a point where you go, you have to budget it out. That's why Dave's budget worksheet helps. Profit and loss will help. It'll help you say, oh, I have net income left at the end of the month, you know, or a statement of cash flows. You can look back and go, I'm doing pretty well, I'm managing my cash pretty well. And then you look at, what can I afford to pay myself? I think that's, you know, you want to go in and know that, okay, and that's, we didn't get to talk too much about projections last night. We went long, but you can put into these, you can project out and say, what happens if I pay myself $1,000 a month, $2,000 a month, $3,000, $4,000? And then you also have to factor in not just that cost of your wages, but also what's my payroll? What are my payroll taxes? Am I giving myself benefits? Workers' comp, all that stuff. What are all these things going up because I'm paying myself? So if you can fit it into your budget, great, go for it. If you don't have sales, if you don't have revenue, you're not ready to even be set up on payroll. But Sharice, I know you're there. So and I'm going to stop and let Dave and Mike and Connie and Kim and Yasmin and whoever else is on to let them talk. That's just kind of my piece here, is budget it. Just run the projections. Can I afford this?
Mm-hmm. But quick question. So when you're ready to afford it, how do you actually get started? That's my question. I mean, I know you got to contact IRS and all those places for payroll taxes and unemployment and all of that, insurance and all that stuff. So how do you actually go through the steps to get started?
Well, let me ask Sharice. Sharice, you said you're going on Monday to set up payroll?
So what I did was, when I opened up my bank account, they actually put forth the people in place for me, just in case I needed them, whether it was payroll or whether it was to get the machine for me to scan in and out. And the guy reached out today, and we're gonna meet, and I talked to him about what it was, and he will talk to you about whether it was your being who you want to pay, how you want to pay, your compensation, benefits, 1099, how you want to go about doing it. I've done it before, but I'm gonna get back into it. But the hard part is when you work for yourself.
Right. So what you want to do, and this is my recommendation to everybody who's doing payroll, whether you own the business or you are the CEO of the company. When I was CEO of the credit union, again, like I said on Tuesday, I had a firm. I had an accountant who did my books and all that stuff, and she was my go-to for everything in terms of operations, growth. But I had a separate accounting firm that just handled payroll for me every month, and it didn't cost me that much for running. The payroll for my entire staff. It was a couple $100 every month, or a few $100 every month. So if you're one person, if you're the only employee you have, and Ronette, I hope you're catching this. If you're the only employee you have, when you go to set up payroll, you go to some place like Sharice has here, go from the bank or through one of the bank's partners, places like Paychex, which is Paychex, or you can go to your local CPA. You can go to your local accounting firm and say, hey, I want to set up payroll, and they will walk you through everything you need. They are experts in that. They have packets ready. They'll say, fill out all this paperwork. And then you'll fill that out, and they'll take it from there, and they will walk you. They would cut my checks for me even, So unless it was like Thursday night and I forgot that I had to pay people the next day, then I'd have to go in and do it myself. And then they would yell at me. But That's, you've got to get with it. Like I said last time, you've got to get somebody else to do it for you. You're not a tax expert, a payroll expert, an accounting expert. You are an expert in your business, not in payroll. Let the experts handle it. Pay a little bit extra for it. It's worth it.
Awesome. Thank you. That's all I needed to know. Appreciate it.
Cool.
Now as I play music, for those individuals who are owners of businesses that are looking to get paid, sit down and have a conversation, quite honestly. The reason for putting together either the budget or the cash flow statement in particular, you're trying to project not only what you're going to potentially spend based on what you need, but you then need to take a look at how much revenue do I need to bring in order to pay myself, especially if you're a single owner. Trust me, there are way too many people who are operating that have enormous difficulty. Well, I can't pay myself. I can't pay myself. Connie made a very interesting statement, and it's like anything else, like even hiring somebody. You have to be comfortable and secure that there's going to be a certain amount in the bank every week that you might be able, and my joke is always eating oodles and noodles. And if anybody's ever read the book Profit First actually does very much that type of evaluation. But you have to be secure about what you're going to sell. Sharice, how many heads or whatever it is that you have to come through, okay, that's actually going to provide you. If I got 40 heads that walk in, I know that I am able to take home a certain amount, okay, and the rest is going into business, because the other part of this is money needs to go back through the business. You can't just keep, oh, I got $5,000 at the end of the friggin' week and pull it out and think you're going to celebrate all the time. And then you got rent, utilities, and everything else that's due Monday, Tuesday, Wednesday, and Thursday. Then you don't have any cash. You know, you got to be smart about it. You've got to be able to plan. And putting the numbers in place gives you at least an idea of what things look like. Like David said, it reflects a period of time, but projections, and Sharice, you're finding this out now by dealing with the bank. The issue is, what is the business potentially going to do? It's a guesstimate, but you have to seriously think about all those things that are involved. And then somebody also made a comment about the benefits component that exists. I'm gonna give you one that nobody ever thinks about as a sole owner. Excuse me, I won't say anybody. Adam, I know, thought about it, but they think about that in the Midwest, okay? Retirement. Okay, you, especially when people are starting out as, you know, single LLCs, single owner LLCs, sole proprietor, guess what? You're not paying in anybody's retirement system. You're really not. You might have an IRA, but it's not coming through the business. So exactly what are you going to do in 20 years when you finally decide, I think I might want to retire? You're going to go to Social Security, which, by the way, you stopped paying into it friggin' 20 years ago. These are the things that you have to think about. This is like a home budget, but you have to think about your future, okay? They touched on it briefly tonight, okay? And several, what is it, a month or so, Adam? There's a piece that I'm gonna show you guys that was created primarily because small businesses were having a hard time in really determining the kind of revenues they needed to make. And the thing about it is, and I'm gonna use y'all numbers, Dave and Adam, for what was shown tonight as a use of an example for the formula that was put in place. And I had to even keep making changes, because when I show people what it really costs to run a business, which includes thinking about not what's going on now, but also the future. I want to buy another building. I want to add 15 people. Come on, what are you going to do? You're going to get so swamped. I think, Adam, you made the comment. You got to look at the numbers in the example. And in the example, she hired somebody because she kind of reached a particular plateau. She lost a little money from an income statement, but the following month, it jumped. because she had that other person to actually help her to produce more of the product and or service that she was actually doing. This is the stuff that we have to take a look at. This is the reason why PathStone has put this in place. Okay, I've talked too much. I love y'all. See y'all Tuesday. Bye.
Thank you, Michael. That's very good. No, that's it needed to be said. And for everybody on the call, I know we got 10 or 15 people left. Check in because Mike's going to have 2 pieces toward the end of the program here. So one of those is the success formula, and we talk more about this. But now I want to get to Allie Lawrence, who has been incredibly patient, and I'm very impressed you stuck around with your hand up this long. Your hand must be tired.
I'm glad it's just a virtual hand. This one's actually a quick question. It's referencing Jaden's question earlier. So in order for people to get as excited about my cheese as I am, I have to sample it. Is that would that be under like a marketing expense, or would that be like a zero cash sale? Would that just be a personal preference? How would I record that?
Yeah, I would call that a marketing expense if I were you. That sounds reasonable. There's probably a couple different ways you could interpret it, but that sounds like a reasonable interpretation. Yeah, you didn't sell it to yourself, so you don't want to overcomplicate it.
Okay, awesome. Thanks.
Is that because it costs her money to make the cheese versus a service?
That's how I would interpret it. Yeah. You want to capture the cost. The key point, you want to just look at the economics of the transaction. You want to capture the cost of that cheese that you ate, that you enjoyed, as you sample it. So.
Okay,
you can
cool.
send some cheese this way too.
No, I meant sampling it to other people.
Oh, well, that's yes, absolutely. Same idea. Yep.
Okay.
Yep. Cool. Cynthia, you've been patient as well. Hello.
Hello. Quick question. I decided to do an advertising thing where it was by accident. I bought 30 bracelets from my company. I thought they were so cute, looks like little diamonds. And I was going to send them to each of my past customers as a customer appreciation. I find out that that's against compliance with my business. So now I have 30 bracelets that I have to move. So I was thinking of, and I already bought the little silk baggies. How do I write that off as an advertisement? I'm going to put them, some are in bags that I'm going to ship to different people just as like a birthday gift or just a surprise. I'm thinking of you, and they're in a little pretty little pink baggie, and I put my business card in a need extra money thing, like trying to team build. So how do I write that off? Is that advertising? And because I have to account for, 30 bracelets and the fee of sending or mailing them. So what do I do? Where do I put that?
But you're not really selling, right? You're not selling them to anybody.
No,
you're just sending them out to people.
I'm just sending them out to people. And
I feel good thing.
Yeah. Because
in the hopes that maybe they'll buy later on, or they might share the information with their family and friends, and you might garner business out of it. I mean, you can certainly build a case that that's an advertising expense.
Okay. Because I kind of got the idea off of Facebook. This lady was going through, and she, I said, well, I'll send her some jewelry. And she said, oh, that's nice. So I said, give me her address, everything like that. And she just got a package full of jewelry. And to this day, I don't think she knows who sent it, but I said, okay, I could do that. So, but I have to account for, the
cost. Yeah.
Cost.
Yeah. Until they are a real customer, I wouldn't call it a sale.
Okay.
Like a no dollar free sale.
You
certainly want to track those individuals, right? Because if you start to get feedback, then
I've got a little file on my computer where I call it free advertising, and I keep the tracking information, if I have their phone number, but I keep the tracking and all of their mailing information so that I have it.
Yep.
You know, but other
So
than
there's
that,
your marketing, that's your marketing database right there. So yeah.
Yeah.
thank you.
Sure.
Yeah.
I hope that was helpful.
Louisa, hello.
No, you answered my question, so I don't know how to take the hand down.
Oh, okay. Gotcha. Okay. Well, good talking to you anyway.
Okay.
Ronette, I think you are the last hand up of the evening.
Okay, and so my question goes again, it goes along with Cynthia's question as far as in alleys, as far as advertising. So I know I was going to buy like 2 T-shirts for myself and one for my daughter. Then I was going to send a couple to Virginia for a couple of my friends to wear. So could I include that as a marketing expense in the cost? So as far as like word of mouth to put out about the T-shirts that I'm selling. Because I'm also going to go to, I have a friend who owns a vegan shop in Florida, and I'm also going to go to start doing like pop-up shops, and so wearing the T-shirts at the pop-up shop. So would I be able to use those, write those off as a marketing expense, or how would that work?
Well, I guess again, I would think about what's the intent of why you're sending those shirts out.
To sell, so I could draw business.
To ultimately make sales. So they're not going out to existing customers.
No, no.
Okay. Then it sounds like an expense to me. And I guess, again, we could call that a marketing expense and rationalize it. So.
Okay.
Yep.
Cynthia, Connie asked a follow up to what we were talking about. There's no way you can return those bracelets?
I only had, well,
because that's your best. That's your best job.
I guess you could, but I think they are so cute. And once I've had people win different things, like I'll play games on my show. And once they win something and they get it, they get hooked on it. So
there's greater value in you sending those out then, it sounds like. Okay, great.
Yes.
Good deal.
Cool.
Is that a wrap?
I think it's a wrap, guys. So thanks for sticking around, everybody.
Thank you, everybody.
Thank you.
Enjoy your weekend. We will absolutely. We'll put this stuff. We'll correct my math mistake and then put it up.
Our math mistake. I should have caught it.
Sorry, and my headphones just died, so I have to hold my phone like this. No, you're good. We'll see you guys Tuesday. Have a good weekend. Stay safe. Wash your hands. Wear your masks. All that, and we'll see you Tuesday. Thanks so much.